Hello, everybody. Welcome to Friday. Looking forward to the live stream today. Hopefully, we'll get a few more people coming in as we get things rolling. But as always, I'm looking forward to the session, and there's always plenty to talk about. We have a couple of trades that are on deck for expiration today, and for the rest, we'll have some others to take a look at for the weeks ahead, and hopefully have some time and some opportunity to open things up for maybe some things that some of you may be looking at as well. Um, so really quickly, since this live stream is being broadcast for anybody who clicks the link, I publish it on Substack for everybody, as well as on Discord right now. Just want to take a couple of minutes and kind of give an overview of the Rebel income system and the trades that we focus on and that we talk about in this live stream. This is something that is a little bit different than what most people may think about when it comes to trading. Good morning, Gabe. So glad that you're here, and thank you. You get the number one mark for the first comment of the day. That's great. Most people, when they think about the stock market, they think about simply buying a stock and waiting for it to go up. If they want to get really, really fancy, they may think about shorting a stock when it goes down. Or if they have a little bit more experience, they start to think about using call and put options. Buying a call when they think the stock is going to go up, buying a put when it's going to go down. The point here is the traditional and first way that most of us think about how to trade and how to try to make money in the markets is by being buyers. We buy the stock, we buy options, those kinds of things. It is far less intuitive to be on the other side of that transaction. If we're always buying, there is always somebody selling. The point of Rebel Income is to actually work that other side of the market and to be the seller, specifically of options, rather than the buyer, and to try to leverage the fact that buyers are wrong more than 75% of the time, on average, and try to use that to turn the probabilities of success in our favor, and to use those opportunities to generate practical monthly income on stocks that we like. This is something that I like to consider as a way to purchase stocks and add to my portfolio with stocks I would already want to own, but at prices that I'm more willing to pay. Right now on my screen, I've got Pfizer, which I have a trade on that expires today. We'll talk about that one in just a minute. But as an example, the stock right now is a little bit below $25 per share. If I can sell a put option with a $24 strike price, what I am doing is saying that I would like to buy Pfizer at $24. The person who buys that option from me then has the right to exercise that option, which they would do if the stock drops below $24. At that point, I can be assigned the stock, which means I buy the stock at $24. If it doesn't, if the stock stays above 24, my put option expires worthless. I keep the premium that I brought in on the put sale. And that's the income component that's the first income component, I should say, that makes up what we do with Rebel Income. Put assignments from put sales in my experience do happen. One of the things I try to emphasize in the trades that I highlight is that you should never sell a put option against a stock that you aren't willing to own. And my method is to sell that put option, and then I hold it through the expiration date. And if I get assigned, I get assigned, because I am looking to use these as opportunities to purchase these stocks that I like. But the reality is that these assignments from put sales only happen probably about 25 to 30% of the time. That doesn't mean that I'm losing the rest of those times. It means that those 25 or 30% assignments, those create opportunities to work with the stock on another level. I work only with dividend paying stocks, and so that provides the second part of the income equation that we focus on. Once I take an assignment on a stock from a put sale, I now hold shares in that stock, and I can collect dividends on that stock if a dividend distribution occurs while I'm holding it. Depending on the direction the stock goes as well, there may be opportunities to sell a call against that stock that I now own. That makes that trade what's called a covered call. Covered calls are opportunities to generate additional income. And if I sell a strike price above, say, the $24 in my example that I'm talking about, then I get the opportunity not only to continue to collect income from those premiums, but also to possibly bake in a little bit of capital gains. And so the idea here is not necessarily to try to time the market, try to take advantage of swings or momentum or those kinds of things, even though technical analysis is a part of what I do when I'm identifying these opportunities. It's really about trying to identify stocks that fit the overall fundamental criteria, that represent a useful value. If I'm assigned, I want to have a fairly reasonable expectation that the stock should be higher. And then from there, just simply trying to work out the probabilities and work with those trades as they come. So that kind of provides the overall context for the way that Rebel Income is built. When you read one of my reports on Substack, you're looking at a stock through the lens of the criteria that I apply to try to find my trades. The trading alerts that I send out will have not only a put sale published, but also alternatives that you may decide to apply as well, such as buying the stock outright and then selling a covered call, or possibly even going with something a little bit more conservative, which is a bull put spread, where you sell both a put option and a call you sell. I'm trying to talk too fast and I'm getting myself confused. With a bull put spread, you're selling a put option at one strike price and buying another put option at a lower strike price. That second put option, the long one, provides you some protection against accelerated downside, and limits how much actual total downside there is in the trade. The premiums, the income tends to be less because you're having to buy as well as sell at the same time. So you create a net credit situation, but it's a little bit less than what you see on a put sale. So those are the kinds of trades that you see me publish through Rebel Income. And I publish a new trade each week, and then I track my trades. We talk about them here. The reason that we do this while the market is open is so that we can see what's happening to the stocks that we're working with in real time. And then we can talk about what that means for the particular trades that we're looking at. And does that change? What kind of impact does that have on the decisions that we need to make? Or what are the other considerations that may come into play? So let's go ahead with that in mind, kind of that baseline. Let's go ahead and dive straight in. I keep track of all of my trades on this spreadsheet called the Rebel Income Track Record. You can get to this from Substack just by clicking on Track Record. And this updates every time I update the spreadsheet with a new trade. But I'm going to go ahead and work off of this. So we can see that there's two trades. One is a put sale on Pfizer, which I already alluded to, and we'll dive into here in just a sec. And then also a cover call on Mosaic. Then we have a number of other trades on deck for the weeks ahead. A number that are setting up for next week, as a matter of fact. So we'll dive into those and have an opportunity to check in to see what those are doing. But let's start out with Pfizer. Now, this is a stock in the full in interest of full transparency and disclosure. This is a stock I've held for some time. I mentioned that when I sell a put option, if I take an assignment, it means that the stock has dropped below the strike price that I sold. Well, with Pfizer, that happened around 55. The stock has dropped quite a bit since then. Let's go ahead and switch over to that chart. I'm going to expand this just a little bit. There we go. And we can see the stock right now is a little bit below, as I mentioned earlier, 25. It's 24.90. Gapped down a little bit this morning to start the trading day, and has dropped a little bit below the rising 20-day moving average. Give me a moment here. Pull up my drawing tool. There we go. So here's the 20-day moving average tracing up. We've got this nice little upward trend, and the stock right now is actually right here around 24.92. So it dropped back down. It was above it yesterday, dropped back down below it, using the 200-day moving average as resistance. So it looks like I may take an assignment here, because I sold the $25 strike price. Now, we are very early in the trading session. We're only 12 minutes into it. So we'll see exactly what happens and where this goes. But as of right now, if this, I'm going to zoom in a little bit closer here. If this gap holds and the stock doesn't find some more bullish momentum before the market closes, then I'm going to take another assignment here at 25. Now, this is one of the other elements that I like to use from time to time, not frequently. But one of the realities of put selling is that you are going to be assigned stocks and you're going to be assigned stocks at prices that are below the strike price that you initially sold. The other element when it comes to trying to find discounted stocks, trading with useful value propositions, it usually means that you're going to be working with stocks that have already been under pressure. And in many cases, more often than not, you're talking about stocks that have been that are in the midst of long-term downward trends. And for Pfizer, this one goes back quite a ways. In fact, the peak of the trend was here in July of 2022, and it's just been falling ever since. So it's, as I mentioned, I first got into this stock at a much higher price at around 55, and been watching it go down ever since then. Now, that might sound kind of silly. Why would you hold a stock through a 50% decline? Well, because the fundamentals have still held. The stock was a really good bargain at 55 when I placed that trade based on the information that was at hand at the time. Those fundamentals have still generally been true, but the market has been discounting this stock in a serious way as it has seen sales decline from its COVID vaccines. A lot of this initial rally that we see in the early stages of the pandemic came on the heels of COVID vaccine development. And as those sales eventually matured, tapered, and began to fall, the company transitioned back to its normal focus on its normal portfolio, which is extremely productive and very useful. But that meant that sales on a broad basis were declining, and so the market has been punishing it ever since. Yeah, Barry, it seems to be dropping in line with the dividend dollar yield, being today is the X date, and that could be playing. That could absolutely be part of what you're talking about, Barry. I certainly agree with that. Here we are. This is the In fact, the ex date is today, 43-cent dividend. So I am going to get this, which is nice. This is the other reason that I've been holding the stock through this downward trend, is because the dividend has remained in place. It's continued to be consistent and productive. And so that's been something that has been worthwhile and has helped me to be able to hold on this and continue to keep an eye on the larger value proposition. This is not a broken stock. This is not a cat trying to catch a falling knife. In fact, if you're not like me, you don't hold this stock at already hold the stock at higher prices. It's an incredible bargain down here in the $24-25 range. Yeah, Barry, a lot of the time stock will slowly ratchet up a little throughout the day on the X days. So we'll see what happens. It's only a little bit off of the $25 strike price that I sold. So we'll see. If I am assigned, that's okay, because part of the reason that I will do this on stocks I've already been assigned is it creates an opportunity for me to average my net cost in the stock a little bit. Excuse me. Just to show you what I mean, rather than just talking about it, if I average these two together, 55, which was my original price, if I get assigned at 25, my average price goes down to $40 per share. Now that's still a ways from the stock's current price, but that changes the complexion of my position a little bit, and it makes it a little bit easier to consider. I've also been able to place a number of productive trades in this stock in the 2.5 years that I've held it. Not only by taking dividends, but placing periodic put sales that have generally not been assigned. And so we'll see. Barry's in this trade as well. Awesome. Barry, unlike me, though, I believe that I don't believe you were holding shares at a higher price. So I believe this would be a new position for you if you're assigned. And again, this is one of the reasons that I published it. It wasn't just about what I could do with my position, but it was also Pfizer at $25. That's a really nice price. Their business is definitely worth a lot more than $25. And so this was a nice trade. That means that even under normal circumstances, a $25 assignment would not be something that I'd be afraid of taking right now. And, the stock does have this nice upward trend that it's been developing since April as well. Now, this is really just an intermediate time frame at this point, but in the context of that trend, even though it's below the 20-day moving average, if you look at the pattern of higher highs and higher lows during this trend, then what you have here is a trend line that has provided pretty consistent support. So even if, okay, Barry, you're in at 28. Even if the stock doesn't recover today, it is starting to approach again this support that my trend line is showing, which means that this could just be another opportunity where this stock is getting ready to stage a little bit of a higher high within this overall upward trend. One of the other elements here that is interesting, talking about the moving averages, is look at the direction of the 200-day moving average, which is sloping down. And what we're getting here between the 20-day moving average and the 200-day, is a narrowing distance between these two. A lot of technicians like to call this a wedge or a pennant, depending on your perspective. These pennants, the closer together the moving averages get, the narrower the trading range between very near-term highs and lows becomes. As that happens, that implies that at some point the stock is going to make a significant move with momentum. And the reason I say that, I liken these kinds of patterns, uh, pennants, flags, uh, wedges, whatever you want to call them, consolidation ranges, especially when they start to tighten. I liken these to a coil on a spring. Think about any kind of a coil that you've seen in a car engine or anything else. The more a coil tightens, a metal coil tightens, the more pressure there is on that coil. The tighter it gets, the more energy there is built up in the coil, so that if you release it, it springs back to its original state with a lot of energy. It expels a lot of energy when it does that. And that means that in the same kind of way, when stocks when they start to narrow, the way that I'm sorry, my hands are kind of all over the place. When it starts to narrow a little bit, it's like that tightening coil. So you expect to see a move with some momentum happen here at some point with some strength. That could be to the upside, and given the current direction of the intermediate trend, which is up, my guess, and this is a guess, not a there's no guarantee to this certainly, but my guess is that it should break higher. It could just as easily, however, break lower and move lower. So we'll see how this goes. One of those catalysts here next week could be, well, 10 days from now. So about a week and a half. Could be the earnings report for Pfizer. So we'll see where this goes. This could very well be the catalyst that forces it to break out of this narrowing range. In the meantime, we'll see where this goes. Barry says if he's assigned, you can start writing calls at 2650, which is pretty close by. And we'll see where this goes. If I'm assigned, that's okay. I'll be happy to take that and just continue to follow the position and watch the stock. We'll see what the earnings report says. If it does continue to move higher, that if you are assigned at 25 and it's a new position, that could set up something very useful. So, all right. Gib, when calling trades, I look at the annual return for an option if it expires and compare it to the annual return of a few stocks that you use for as benchmarks, specifically spiders, the S&P 500, the NASDAQ, the Dow, and BIL. Okay. I'd like to see your ROA be greater than the net asset value 1 year. That's fine. Whatever your preference is, I'm not necessarily trying to beat the indices. For me, the expectation here is really, really simple. I'm looking for an average of about 1.5% premium on every put sell trade that I make. I'm trying to get about 18% net return on my capital per year. So I break that down per month. It's about 1.5%. So I set a very conservative target. That means sometimes I do beat the S&P 500. Sometimes I don't. You'll get these really, really bullish years where the stock market will S&P 500 will go up 30, 40, 50%. I don't. That's fine. I'm not trying to play catch up with the market. I'm not trying to keep up with it in any stretch. I'm just trying to place functional trades. That said, I have no problem if that's something that helps you to filter through your trades and decide on things that you would like to use. We all have our own preferences and styles, and that's awesome. One of the other members of our community who's been in some of these live streams in the past mentioned that he likes to look at he likes to try to target a 30% annualized return on his invested capital from his trades, and that's fine. So he's looking for a little bit more. He's looking for about 2.5% as opposed to 1.5%. That's okay. that he's still using the same overall principles. He's just applying it in a little bit different fashion. But I appreciate that question, Gib, because this is one of the things that I try to emphasize. It's don't just place the trades that I'm placing. I send you these alerts so that you can decide if you do want to place the same trade. If not, what are some other variations that you might be able to do? And in the same way, how does the information I give you about, say, a trade on Pfizer, maybe you just decide to try to apply the same principles, the same criteria to some other stock, and that's okay too. I love it when I see people placing those trades as well, because that just means you're finding ways to use the same information in different places, and that's the whole point, right? Is trying to find ways to be able to use the market and turn the probabilities of success in your favor. Um, that's really all any of us are after, trying to maximize the opportunity that we have in a way that makes sense. So if that helps you, that's awesome. All right. So that's Pfizer. Now, with the stock's current price action in mind, let's go ahead and refresh this. There we go. Let's make sure that we have current pricing information. There are people who like to generate income using put sales and place the same kind of trade, who are their preference is different from mine, and they don't want to take an assignment. That's okay. That means you're going to be more active about managing the trades that you place. Barry, not being called out on MGA last Friday at 42.50, able to write an 8:15.45 call for 90. Awesome. Just keep the income going, right? You just keep that machine running, which is awesome. Let's just check in for. I appreciate you sharing that one. Let's take a look at MGA really quickly. Oh, good heavens. There we go. Yeah, so you're able to sell a covered call. Looks like a couple of days ago while I was rallying up towards 44. It's pulling back a little bit now, but you've got about 3 weeks to expiration, so that's a good trade. And if you do get up there, here's 45. That's have a stock that is showing quite a bit of momentum to get up to that level, and you're in at 42.50, which means you get a nice little capital gain if you are called out. If not, that's a nice covered call, right? A little over 2%. All right. So the idea that we want to talk about with Pfizer now is, if you don't want to take an assignment, what do you do? Well, the simple method, the simple answer is buy the option back. Now, for context, let's just run the numbers here. Here is my original put sale. I brought in 60 cents on this when I placed this trade. It was a nice yield of about 2.4%. But this 60 cents is the number that I want you to keep in mind, because that's something I brought in as an immediate credit to my account when I placed the trade. Now, if I wanted to avoid the assignment, this is the $25 strike price, and here's the put option. Since I sold the put to open the trade, I would have to buy it back to close it. Literally speaking, I've just given you the language used for the trade. You sell to open and you buy to close with your broker. That means that I always have to buy at the asking price. So in this case, I'd be buying at 30 cents. Remember, I brought in 60 cents when I sold the put option. So even though the stock is below my $25 strike price right now, If I were to buy this back at 30 cents, and some people in our group would be like, hey, put it in at 27, put it in at the bid. You'll get a little bit, you'll keep a little more premium that way. That's fine. But let's just say that I decide not to monkey with that, and I just buy it back for the 30 cents. I still hang on to 30 cents of the premium. So the trade ends up being a little over 1% in that case. That's interesting because I still have a net positive result here. Also, buying it back right now would remove the potential obligation associated with the put sale. I could be assigned at any point, not necessarily after the market closes. With the stock below it, I could be assigned at any moment. Kind of unlikely. It's with the stock as close as it is, it's more likely I'll just be assigned once the market closes, assuming the stock stays below this current price. But this positive credit does offer an opportunity to think about maybe there's some logic to buying it back early, immediately closing the obligation. This also frees up the cash that I use to reserve the trade. The $25 strike price is a good reference to think about what you have to put on reserve for these put sales. Thank you, Barry. We'll you're 1 or 2 steps ahead of me. I appreciate it, but we'll get to that. With 25 being my reference point, being that my strike price, that means that if I'm going to buy it back, means that when I sell the put option, I've got to keep $25 per share per contract in reserve on my account at all times in order to fulfill and meet a potential put assignment. I sold 1 contract, so that means that I have to be able to purchase 100 shares. So $2,500 is the reserve requirement in this case. If I were to buy this back, that immediately frees up that $2,500. So then I can redeploy it, which then begs the question that Barry just answered. So let's take a look at that. The next question is, what do you do with the same capital? Right now, I'm planning on taking the assignment, so I'm going to be holding those shares. But one of the other things you can consider at this point is, do I maybe consider selling a new put option on the same stock? Maybe. If I go to 24.50, which is the closest strike price that is out of the money, here 7 days, it's a little under 1%. This is interesting. 2-week trade, not a recommendation to buy or sell, but here's 24.50. If I bought this back, still hang on to 30 cents per share of the original premium I brought in, can sell out for another 2 weeks and bring in 40 cents on the bid right now. So my net credit for both trades would be 70 cents. But 24.50, 40 cents brought in for the next 2 weeks means that there's a pretty nice premium available here for a 2-week trade. Divided by 24.50, oops, sorry, 0.4 divided by 24.50, there we go. 1.63% for 2 weeks. That's functional. So that's interesting. Another reason that you could or might decide that you want to buy this back is, number one, you don't want to be assigned at 25. You just don't want the assignment, as Barry is saying. The other possibility may be, not only do you not want it, but you also have found another stock that you would like to work with. You'd like to be able to use the same capital with better. But the question, if you are going to think about rolling and being more active in managing these trades, the question that you have to answer is always, what are you going to do with the money next? So what is your plan? How are you going to deploy it next? You certainly don't have to necessarily have your next trade in mind or planned. But it is, what are you going to do with the money next? Maybe you just don't like the way that the market is going right now. Maybe you don't like the current conditions or whatever it is. Maybe it just makes more sense to close it out, sit in cash for a little while, and let the market work itself out for a little while. Sometimes that happens. I don't feel like that's where things are right now, but I'm saying that could be another possible answer. Maybe you're going on vacation and you just don't want to have to worry about checking in on your brokerage account while you're on vacation. Could be a few different possibilities. All right, so that's Pfizer. The other trade that is on deck for expiry today is covered call on Mosaic. Now, to be clear, this is another stock that I've held for some time. I was not originally assigned at 38. This is the strike price that I sold. I was assigned shares at a much higher price, but by selling covered calls against that position, the dividends that I brought in, even some put sales that where I was assigned additional shares and averaged my price a little bit lower. I was able to. I've been able to bring down my net cost basis to a little bit below $38. So this particular covered call was an opportunity to free up all of the capital that I have in those trades. I've got 200 shares now in this one at around a net average cost of about $37.80, roughly. So let's check in on this one. MOS, Mosaic, is a stock in the materials sector that I like. Currently a little bit below 37, so looks like I'm going to hang on to my shares for a little bit longer. I did set to be fair, a pretty ambitious covered call trade. 38, the top is a little bit above the stock's top of the range that it's set here at the end of June, the beginning of July. And that's providing pretty strong resistance right now. It is also starting to develop a consolidation range here with a high around, I don't know, 37.75 roughly, and a little bit above 35. That's also kind of like, that's like the start of a tightening coil. So it could consolidate for a little while, and then we'll see what happens after that. That could possibly drop back down out of the range and revisit some of these lows again. Maybe if this earnings report doesn't come out great. If it's favorable, if the market likes it, it could push back up and it could experience a whole new surge. So we'll just have to wait and see how this one shakes out. But it does look like I'm going to hold my shares for a little bit longer. And that's fine. This has been productive and it's been useful. Even if it does drop back a little bit, it just means I'll hold on to a little bit longer and keep taking dividends. So that's Mosaic. We'll see where that one goes. If you have a similar position in that one, you want to share your numbers, please go ahead. Let's see. Let's talk about CVS. This is a put sale that I placed in the middle of this month, about 10 days ago, and selling the $62 strike, brought in about 3%, which was a pretty nice trade for a 2-week period of time, scheduled to expire next week. So let's see where CVS is sitting right now. All right. So it peaked up here at about 70. And it was starting to drop off when I sold my put sale. This is the strike price that I sold at 62, and we can see that the bearish momentum on this has just been accelerating. Again, this is another one that is coming up on an earnings report. So volatility is picking up here, and it looks like the market is betting bearish. Earnings report is comes the day before this trade expires. So what do you do with the trade? What does that mean? I try to include information about these earnings reports when they come up, and I try to remind you not to. I don't necessarily clearly avoid holding a put sale through an earnings announcement. I'm not necessarily afraid of those. However, they do introduce an element of volatility, not always risk, but volatility, where you're going to see the stock become quite a bit more variable than normal. And that's what's happening right now, is the stock is clearly picking up bearish momentum here. And I think that we've got a clear indication the market is betting on some less than favorable information on this. And if that's true, if that holds through next week, then I'm going to be assigned at 62. Again, this is the, sorry, that's ugly. This is the 62 is the strike price that I sold. So it's a little below 61 right now. With the stock a week away from expiration, this is a good opportunity to talk about, do you need to take preemptive action to try to minimize loss potentially? If you're afraid of additional downside even below where the stock is at right now, look at here's the 52-week low. This came up in December of last year at below $44. That's significantly below the stock's current price. Maybe you don't want to deal with the possibility of that kind of downside. And that's fair. I'm not saying that I'm impervious to it, because I'm not. But I also believe in the stock's fundamentals. I believe in the value proposition, which is nice for CVS right now. And so I like it at 62. Even with everything that we just talked about here about the stock's price, and even with this current increasing bearish momentum, I still like the stock at 62. Part of the thing that becomes a little bit of a challenge here under these kinds of conditions is remembering the reasons that you place the trade in the first place. And for me, this comes down to some of the core principles that I've built Rebel Income on. I mentioned at the beginning of the session today that this is really not necessarily about trying to time the market. I'm not trying to take advantage of near-term swings in momentum or price, although sometimes that does happen. What I'm really focusing on is the value proposition. If I'm selling 62, is the value proposition for the stock significantly above it? This is borrowing from some of the core principles of value analysis that have guided a lot of successful investors. And it's a precept that is kind of the core one of the core principles behind value analysis, as defined by the man who taught Warren Buffett. As I've built Rebel Income, I spent a lot of time reading Buffett's letters. They inevitably led me to the works of Benjamin Graham, who was a professor at Columbia University when Buffett was a student. Buffett had published a book in the 1930s called The Intelligent Investor. It's never gone out of print. I bought it, I read it. And one of the core principles of that, one of the core takeaways that I got from that book was that if a stock is worth $62 in my example, it doesn't really matter what the stock's price action right now is doing. It doesn't totally dismiss it because we have the emotional component of price movement that we have to deal with. But if the stock is at $60, $62, Gib, you tried to read it. I tired to read it. It's not light reading, that's for sure. But if the stock is sitting at 62, but it's worth a lot more, it's worth $80, $100, whatever the case may be, then whatever may be happening in the near term is really just noise. And so that's one of the things that I try to remember, in these kinds of situations. Again, that's not dismissing this momentum. That's kind of scary looking. But this is where I try to remember what I've built my system on. And so I may take that assignment at 62. That's fine. That doesn't bother me. Yeah. And it declared a dividend on the 22nd. So it went ex-dividend on the 22nd. So, yep. Carl, what do you mean by CD? Oh, the book. I'm just catching up to you. Yeah. You can also read it you can also listen to it as well. It doesn't mean that it's going to be any easier to listen to, but very good book. I do recommend it if you're trying to understand some of the core principles of value investing. It is kind of required reading. And it is interesting, a book that it's 100 years old has never gone out of print. That says something about the value of what that information gives. Hard to stay awake. Which you want to do while you're driving, so make sure you're listening to something that will keep you awake, right? So that's CVS. We'll see where this one goes. But again, in terms of thinking about what to do with the trade, here is the option chain for the first. And remember, on this one, I brought in $1.90. So here's the premium I brought in. That was pretty nice at the time. If I wanted to buy this back, if I wanted to avoid the assignment here, I'd be paying $3.15 at 62. So I'd have to absorb, excuse me, a loss of $1.25. Now, here's the reason that might make sense. I sold one contract. If I'm afraid of that additional downside, if I don't want, and maybe it's not afraid of, right? Maybe it's just that your style, your preference is different from mine. If your preference is to manage your trades more actively than I do, then buying this back at $3.15 means absorbing a $125 loss on the one contract that I sold. But it's $125. The stock drops down to, say, 45 from where it's at now. That's $15. That's $1,500 on paper that I would have lost in that position. So 125, 1,500. That actually, sounds like pretty easy math if you don't want to have to deal with these downward trends, if that is your preference. And if you are somebody who prefers to trade more actively, you're going to increase your trading frequency versus what I do, which I consider to be a positive thing. You're going to increase the compounding effect of these income trades that you place. But that also means that limiting your loss on trades like this really becomes of prime importance. So buying it back at 315 is actually not that terrible. Does mean that you're going to have more losing trades than I do, but you're also going to be placing more trades than I do, and so your winners are still going to do you better when all is said and done in the long run. So that I'm trying to present this is there's different ways to manage the system. There's different decisions to make depending on what your preference is. I have a very clear my preference is very simple. I sell the put option, I let it expire, and the result is the result. I don't avoid put sell assignments because I want to own these stocks anyway. Not everybody is going to use put selling for the same purpose and in the same way, and you shouldn't have to. So the point of looking at this is to evaluate how you try to manage those trades if you are going to do different. In this case, that would probably make sense. Okay. And if you're working with CVS as well, and you have a different idea about how you would want to work with this, feel free to shout that out too. Nothing wrong with that. Okay. A couple of covered calls that are coming up next week. One on Barrick Gold, another on BWA. I want to focus first on the put sell that I send out for this week's trading alert on Delta Airlines at $55. So let's take a look at that one. This is a 9-day trade. So this is a very, very short-term trade, bringing in about 1.5% for 9 days, which is, in my book, a nice result, and on a company that is showing some nice strengths in the airline industry and has been recovering a bit from April, even if its momentum right now is trailing back just a little bit here. Now, again, for reference here on this trade, I sold the $55 strike price, brought in 85 cents. So keep 55 in mind. Stock is a little bit below that. And it gapped up. We saw a really big move higher after its earnings report. And the market is seeing it taper off. It's starting to maybe consolidate a little bit since then. The 20-day moving average here should be in a position to provide support right here around 53.50. But my assignment price is up here at 55 or 54. Sorry. Nope, 55. Sorry. So if this were next week, it looks like I would be taking another assignment here. Again, I'm not that doesn't really bother me too much. I don't mind that. Taking an assignment, if the stock does drop and I take an assignment before the first, opens up the possibility of maybe being able to get this dividend, which would be nice. But I don't expect it. So we'll see. Any of you that are also on this trade? Gibbs says, hope it doesn't do the December to January pattern. Well, December to January, this wouldn't This wouldn't be terrible. I think what you're talking about is what happened here from February to April. It could. Not going to dismiss that. This is an airline stock, and so airline stocks can be a little bit, they can be a little bit volatile from time to time. But again, the core value is definitely here for Delta. 55 is a nice price. That's why I sold that put option. So I'm not afraid of that. Even if it does fall, it does kind of repeat this pattern and test these lows. Some of this, obviously, in March, a lot of that was related to the initial tariff fears and shock, right? So that had nothing to do with the company. That was just the market reaction to everything, or for everything to tariffs, I should say. This increase since then has been more about the overall strength of the company. So if that strength continues to hold, and as of the most recent earnings announcement, it has, if the fundamental strength of the business, if that narrative continues to hold stronger than whatever other concerns there may be, tariffs or interest rates, those kinds of things. If the fundamental strength of the business continues to be the primary narrative, then it should hold up. That does not dismiss the possibility. If we see a resumption or an escalation in tariffs, for example, if some other things, maybe interest rates continue to stay very elevated, and we start to see one of the things that's been impacting Delta in a positive way has been an increase in business travel and business travel demand. If that starts to taper off a little bit again, then that could provide a headwind that could also pressure the stock. So we'll see. I don't expect that. That's the kind of a trend that takes time to reverse. Those usually don't reverse very, very quickly. 2020 notwithstanding. Pandemics don't count, right? Because they kind of break all the rules. Okay. So those are the put sales that we're really looking at and paying attention to right now. With those in mind, Barrick, here is a covered call. This is a stock that I hold at 2050. I was able to sell the 2150. Sorry, I keep calling it Barrick Gold. They changed their name to Barrick Mining. And if current price action holds here, it looks like I'll be called out of that position with a nice little gain. That's kind of nice. And I've held this one for quite a while. This is a stock that I like to use and kind of keep in the rotation from time to time as a hedge against things like interest rate risk and some of those kinds of things. And so fundamentals are very, very good on Barrick. They always have been. If I get called out, I may turn around and look for another put selling opportunity on this one. We'll see. You've been seeing a lot of news about metals. Yeah. Precious metals tend to act as a hedge a little bit against economic risk. So when economic uncertainty is increasing, whether that's being driven by interest rates or other elements, then you often see, we hear about flight to quality, right? That doesn't just mean that people go out of stocks and they start to go into bonds. One of the things that they'll also start to do is they'll start to increase purchases of precious metals. which is part of the reason that I like to try to keep some metals as a mix in my overall portfolio. We'll see if that momentum continues. The other cover call was on Borg Warner, and we're pretty much at time, so we'll just check in on this one really quickly. I own this stock at 35, or excuse me, 32.50. Let me take that back. I own this at 32.50, so if I get called out at 37.50, that's an opportunity for a pretty nice capital gain on top of what I've been able to bring in premiums. Now this one doesn't happen until August 15th, so this has got a little while to shake out. But here's Borg Warner topping out here about 37 a couple of days ago. It's been tapering back pretty strongly, but we'll see. Again, this is a cover call trade I placed ahead of an earnings announcement, so I was able to get a lot of premium because implied volatility on these options is being exaggerated and inflated ahead of that earnings announcement. So we'll see. It could easily drop back again below 35 if this earnings announcement isn't taken favorably. So we'll see where this goes. But Borg Warner is another company I really like. I have liked for quite some time. This is the momentum for the past year or so, but it is really fighting a longer downward trend going from a high about 48 back in 2021. So it's actually relatively, not only relatively, but it's actually very undervalued right now. So that makes it interesting. All right. Well, we are at time, so we do need to close it, but I appreciate everybody being here and your participation as always. If you have any questions or anything comes up during the week, don't hesitate to reach out to me. Let me know. You can message me directly on Substack. If you're on Discord, you can do that as well. Or email me at rebelincomesystem@gmail.com. So here is the email address. Just put it into the chat area. You can reach out to me there as well. In the meantime, I hope you have a wonderful weekend. Enjoy your week, and we'll talk again next time. Thanks, everybody. Have a great weekend.